Sponsored by Centavos. Keep more of your money.
What's up, everybody? Welcome back to Ask Sloan. Guess what? I'm Sloan. And today I want to talk to you about something that is absolutely near and dear to my heart. It's the number one question that I get, right? You already know I grew up with a CPA father, and I've done taxes for a living for, going on 30 years now. I help small business owners achieve their financial goals. And the number one question that I get is, honestly, how do I save money in taxes? It's the number one question I get. And I know today there is so much information out there about how the rich don't pay taxes and you don't have to either. And if you just act like the rich, you can do it too. And if you have a trust, you don't have to pay taxes. And if you're in real estate, you don't have to pay taxes. And you can make all this money and never pay any taxes. And today I really want to kind of separate the truth from the noise. I want to really help you understand how those games work, how they're played, whether or not they're for you. And really, I want to lead you to making great decisions for your financial future, and how to do that. So the first thing I'm going to do is I'm going to ask you, do you want to be wealthy or do you want to pay no taxes? Okay. And most of the time, 90% of the time, those are two different things, okay? There is one exclusion that I know about, one way where you can do both. You can build wealth and reduce your taxes dramatically, and that's through a couple of different real estate plays, okay? And one of those real estate plays is buying income generating properties using a cost segregation study to depreciate a majority of that asset in its initial year. Okay. And I know I'm using a bunch of big words there. Okay. We'll break it down a little bit. All right. And then later selling that property through what's called a 1031 exchange so that you don't have to pay taxes on the gain. Okay. And you can continue to do that. That is a game that you can continue to play, a perfectly legal game. All the tax code supports it. It is something that the super wealthy do. And it is a game that you can play too, but it's not a free game. And it doesn't mean you get to keep your money. Okay. So the first question I'm going to ask you is, do you want to keep your money? And do you want to spend it on your personal lifestyle? And if the answer to that question is yes, then no, you can't save money in taxes by doing that. Okay. The number one way to save money in taxes is to spend it. Okay. You can only do two things with your money, right? Just two things. That's it. You can either spend it or save it. That's it. If you spend it in a way that is tax deductible, you will reduce your savings. Let me give you one way that's tax deductible that you can spend your money. And this is a pay yourself strategy, okay? You can put that money into a retirement plan, okay? Retirement plans are either tax deferrable, meaning I don't have to pay tax on that now. I can pay tax on it later, or they're tax deductible later, not now. They're used after tax dollars, but when you pull it out, you don't have to pay any tax on that gain, okay? Those are Roth products, and the products before are traditional products, okay? And these are financial products that you can purchase, and it's a way of paying yourself. But you don't get to keep the money. You have to put the money over here, okay? So if we're talking about a net, and let me explain this, okay? Cash in, cash out, right? If you want to keep the money, you can't keep the money and not pay tax. If you want to put the money over here for you to have later when you're much older and you're retiring, okay, and that's what you want to do, then that is a great thing to do, and that will lower your tax liability. Now, how much lower? Well, when you spend $1, you save 20 to 30 cents. Okay. And this is the part where you might want to get out a piece of paper, start writing a few things down. Okay. If you spend $1, you're going to save 20 to 30 cents. Okay. So if your taxes are $100, okay, that's how much you owe in taxes. Okay. You have to spend $300 to get rid of those taxes. Okay. So let's say your taxes are $100. Okay. And let's say you want to reduce those taxes to $50. Okay. So then you're going to go and you're going to spend $150 to reduce the taxes to $50. And then you're going to pay the $50 tax. Okay. So you're going to spend $200 to save $50. Okay. If you want to keep the money, then you're going to spend $100 and you're going to keep $100 in your pocket. So the question becomes, do you want the $100 in your pocket or do you want to spend $200? Right? So that's really where you have to pay attention to where your money is going. And that's how it works everywhere, right? So if you go and you purchase a property, if you borrow money to purchase that property, okay, then you depreciate it. That's the expense. Let's say you purchase a $100,000 property, you borrow the money, okay? Let's say you put 20% down. So you put $20,000 in, okay? You borrow 80 grand. Now you got a $100,000 property. You do a cost segregation study and you're able to write off 40% in the first year. So now I'm going to have a $40,000 deduction. So I paid $20,000 to get a $40,000 tax deduction. So I still paid $20,000, but I'm going to get a $40,000 tax deduction. How much is that $40,000 going to save me? That $40,000 is going to save me $12,000 to $15,000 in taxes. Okay. But then now I have a property. Okay. And I can essentially, borrow money against that property, but I can't right now because, of course I got a loan to buy the property. But if I own that property outright, I could borrow money against that property. And borrowed money is non-taxable. Okay. So that's part of the reason why that real estate game works. Okay. Getting back to where you're putting your money, spending it or saving it. Okay. If you're going to spend your money can only go in one of three buckets. Okay. That's the $0 bucket. That is the $1 bucket. And that is the $3 bucket. Now I came up with this whole bucket concept when I was working for a client who was struggling. He had purchased several locations and was basically growing a little bit too fast, and got himself, in a mountain of debt. And his debt service, meaning the amount of money they had to spend on debt every month, was $85,000. Okay, which is a whole lot of money. Okay, and so it was burning his cash. And so he didn't have enough money to operate. Okay. And so when you only have a certain amount of money to work with, as the chief financial officer, I was trying to figure out, okay, where do I put this money? Because I have to spend it no matter what. Where can I put it to generate more dollars? Because there was nothing else we could cut. We couldn't get any slimmer. We couldn't cut any more expensive. We were not overspending. He wasn't even paying himself. We were underspending. We were asking our vendors to give us credit. We were doing everything that we could to stay afloat. So there was nothing else that we could cut. So what we had to do was we had to make more money. Okay. But my job as a chief financial officer is to spend it. I wasn't capable of doing any additional sales. I wasn't on the sales team. I wasn't the one generating revenue for the company. I was the one in charge of spending the money. So I thought to myself, where can I put this money that's going to generate more dollars? If I put in $1, I get $3 back right now. So $0 bucket, $1 bucket, $3 bucket. The $0 bucket, you put $1 in there, you get nothing. Okay. I love ice cream. Big fan, right? That's a meals deduction. So it's a 50% deduction. And I literally have nothing to show for it. It's a consumable. Okay. So anything that you purchase that does not generate revenue and has no value long term is the $0 bucket. Okay. The $1 bucket, that's the bucket that has value later. Okay. So think about your house. Okay. Your house is a $1 bucket. You're putting dollars into your house, into your mortgage, into repairs and maintenance, into renovations, remodels, whatever. You're constantly putting money into your house. Okay. But one day, when you decide to sell, you're going to get money back. Okay. Now, if you do the math, just depending on how the market flows, you could just get your money back, all the money that you spent, all the repairs that you made, all the interest that you spent on your loans, or you could make a small profit, again, depending on the market and depending on how long you held that house and what those situations were, so on and so forth. In some cases, you could lose. Maybe you don't do any of the repairs or anything, and you have to sell that house as is, and you don't even get your money back. But you get some money. It has some value. It's not a $0 bucket, okay? And it's something that happens later. It's not something that happens right now, okay? And then there's the $3 bucket. The $3 bucket is the bucket in which you put $1 in it and you get $3 back. Now, this is really for business owners, okay? Very difficult, okay? For all of my individuals who have a job, you're making money, your $3 bucket, we're going to simplify it for you. It's investments, okay? And there's a whole lot. We'd have to do a whole show just on investments and what types of investments there are and so on and so forth. And of course, there's a ton of information out there, but we definitely will go into those topics so that you can understand where you should be putting your money. But that's for another show. Okay. So, but for small business owners, okay, to generate more revenue in your business, you got to figure out what your $3 buckets are. Okay. Now I'm going to give you a clue. Okay. The number one clue, if you have a cost of goods sold section on your profit and loss statement, that section is a part of your $3 bucket. Okay. And the reason why is because you're purchasing things to sell in that section. Okay. So cost of goods sold. Okay. And a lot of people use this section incorrectly because it's really not for services. It's a whole lot more for products. Okay. Because what you're doing is you're buying raw materials. You're paying for labor to assemble those raw materials into products. Then you're selling those products. Okay. And so as an example, it costs you $10 to make a widget that you sell for $30. That is the $3 bucket. So you purchase enough inventory and enough labor to produce that product that then has stored value that you can go sell in the marketplace. Of course, you got to have somebody selling it. You got to have somebody getting it off the shelves. Otherwise, you're not going to be able to capitalize on that. So you don't, inventory sitting on the shelf is costing you money. So there's a lot of problems that could happen there, but that's your $3 bucket, right? Create inventory, sell it. When I ran a hot rod shop for several years, one of my best friends, and I realized there that our $3 bucket were our technicians. Okay. And we had a paint booth, we had a metal fab station, we had a powder coating place. So the more technicians that I had generating billable hours, then the more money that we made. Okay. Now the key word there is billable hours. Okay. So how many billable hours can I get going in the shop? So we went from having 2 or 3 technicians doing billable hours to having 10 to 12 technicians doing billable hours. And we literally tripled our revenue by doing that. And so the more money that I put into labor that generated more billable hours, then the more money that the company made. Okay. And so as an example, I paid our team $25 an hour and we billed $85 an hour. Okay. So that's the $3 bucket. Another $3 bucket is going to be effective advertising. Okay. So you've got your product or service on the other end of that ad. You pay for ads. People purchase it. Boom, $3 bucket. Okay. And the curve on marketing and advertising kind of goes something like this. It's actually kind of like this. I'm doing a very bad drawing. But the situation is such that it is not a straight line up. Okay. It takes 3 to 6 months for advertising campaigns to really get traction. So you're going to spend 3 to 6 months worth of dollars before you get that return on investment. So it takes a little bit of time. It's not necessarily, tomorrow that you get your investment back if you do it properly, but it becomes exponential. Okay. So as long as you're ready for that scale, that works. Okay. So why do we talk about that? And what does that have to do with saving money in taxes? Well, the situation is such as this. Do you want to save money in taxes or do you want to build wealth? Is that really the question? Okay. Because most of the people that come to me and say, hey, honestly, how do I save money in taxes? The number one reason why is because they really want to build wealth. They really want to have more money. Okay. And in order to have more money, we need to have the right money mindset. Okay. Money is psychology. Money is all about, keeping more of your money is all about having the right psychology and the right relationship with money. So let me ask you, how do you spend your money? Do you budget it? Like, do you know where your dollars are going before they go? Or do you base your spending on your passions and your impulses? You go shopping and all of a sudden you're buying stuff, or you see your friends having things that you want, and so you go get them, or it's Christmas, so we have to do the Christmas thing. Like it's really important that you sit with yourself, sit with your spouse, sit with your team, sit with your partners, and you understand your relationship with money and how you spend it. Okay. And in that way, you can start putting it in the right buckets. Okay. And you can get it to work for you instead of just kind of doing whatever the thing does. Okay. And so if money's not working for you, it's because your perspective is not in the right place. Right. So what do wealthy people have? Wealthy people have money. Exactly. Okay. They have money. So, what do you have to do to have money? You have to save it, not spend it. Okay. So let's rewind. In order to save money in taxes, I have to spend that money in a tax deductible way. But if I want to keep my money and build wealth, then I'm going to have to pay taxes. Okay. So if you get your piece of paper out that has that $1 and that 30 cents over here, what's in the middle? $1, 30 cents. What's left over? 70 cents. Here's the question. Do you want that 70 cents? What do you have instead? What if you just spend the dollar so you can save the taxes? What do you have left? A big fat zero. So do you want 70 cents or do you want nothing? If you spend your money in the right ways, then yes, you could have assets. Yes, you could have retirement. Yes, you could have those things. If you have enough money to do those things, I 100% and highly recommend it. But to be truthful with you, most people come to me asking to save money in taxes. It's not because they have too much money. It's because they don't have enough money. They don't have enough money to pay their taxes. So if you're someone who's got plenty of money to pay your taxes and you want to reduce those taxes, then yes, go get into the real estate game. Go put that money into retirement accounts. Talk to a financial advisor. Really figure out how to get your money working for you. I 100% do not necessarily suggest you go out and buy a whole life insurance policy. There are a bunch of people that will sell you that. That is a great product for some people, but be very careful. Okay. It does not save you money in taxes. But most people who ask me, how do I save money in taxes? Is because they don't have it. Okay. And so the answer is not, hey, go put that into a retirement account that you can't touch for the next 30 years. Okay. So the real thing is change your perspective so that you start to have money. Okay. So you start keeping more of your money. Right. And that's our mantra at Centavos. Keep more of your money. Okay. And then as you develop your wealth, as you stack your cash, then you can start to take that 70 cents. It's the most valuable 70 cents in the world. You know why? Because it's after tax dollars. They can't take it from you. Can't take another dime out of that 70 cents. And if you get used to that, you get used to the understanding of, hey, if I'm going to go make money and keep it, I need to pay some tax. Now, I'm with you. $39 trillion in debt. Why are we giving our government all this money? What are they doing with it? So on and so forth. But if we just step out of the political, emotional ring for a moment and we recognize that we live in a country that the majority of that spending goes to protecting us, our armed services, and that's a true statement. The majority of that money goes to our armed services. There's a whole bunch that is wasted and all that stuff in a bag of chips. But the only way to kind of deal with that is with your vote, okay? But at the end of the day, okay, I'm happy to pay my 30 cents, okay? I'm not happy about what they're doing with it, and there's other arenas to argue that, okay? But the truth of the matter is that I want to make money and I want to keep it, so I'm going to pay the tax on it, and I want to have the right perspective so that when it comes time to pay that tax, I have it. And then when I have money, then I can do things like start a business, okay? I can do things like play the real estate game, okay? But I'm going to be honest with you, the real estate game is not necessarily my game. I'm an entrepreneur. I understand business, and so that's where I lean. I've got clients that are great at real estate. They love it, okay? I'm going to tell you why I don't like it, because it's constant repairs, constant delays, constant this. Everybody I know in real estate is like, hey, this is how much I want to do, and so on and so forth. Their numbers don't always work out. Their margins end up getting slim. The market takes a turn. I mean, the market here in Houston has been dead for like 2 years. It's been real tough. So all my people in real estate are having a really tough time. But the game that I taught you in the beginning, the cost segregation game, you got to buy real estate every year for that game to keep working for you. Every single year. It's not a one and done thing. I have to keep doing that thing. So if that's how you want to live your life, being in real estate, then great. That means that game's for you. Go play it. But I also know a bunch of people that game doesn't work for them. So if you're just running around trying to figure out how not to pay taxes because you don't have any money, the problem isn't that you have to pay taxes. The problem is your mindset with money, okay? And I'm going to give it to you. I'm going to give it to you right now. It's called the 50-30-20 plan, okay? And there's a ton of information out there, and this is a benchmark. This is a foundation that you need to lay. The 50-30-20 plan, okay? And I'm going to be real honest with you. It is really difficult to do that, okay? So you need to modify it. You need to modify the 50-30-20 plan to fit your current situation, and you need to grow into it, okay? You need to grow into it. The 50-30-20 plan goes like this. You live on 50% of what you earn, okay? Now, if you're a business owner, you've got two profiles. You've got a business profile and a personal profile. And so that 50-30-20 plan is for both. Too many of my clients are treating them like they're one. They're not one. If you want to build wealth, you've got to separate them. You've got to have different game plans, and you want to keep your business healthy, okay? And then you want to keep your home healthy. Now, look, the first 5 years are really tough. A lot of small business owners don't pay themselves in the first 5 years. It's a really difficult situation, so I totally get it. So then, if you can't do 50-30-20, well, let's finish defining it. Live on 50% of it. Save 30% for taxes. And 9 times out of 10, you're not going to pay 30% in taxes, okay? If you make less than $200,000, your net tax rate is going to be somewhere around 18%. It's great, okay? So then you're going to have 12% left over. Okay. Which is awesome because then now you got more money. Okay. And this is what we want to do. We want to be wrong on the right side because we can't be right. It's impossible to get these things exact. But when we're wrong, we may be wrong on the right side, which means I have more money in my pocket when I'm wrong. So live on 50%, save 30% for taxes, and whatever's left over, put into the next bucket, which is that 20%, and that's long-term savings. And what do you need in that long-term savings bucket? That's your investment portfolio, okay? You need long-term care, you need retirement, you need investments. If you have a diversified portfolio, you got a little bit in stocks and bonds, you got a little bit in crypto, you got a little bit in real estate, okay? There's a myriad of different ways to break that up depending on your risk profile. 50, 30, 20. How do I do that? How do I do that? Well, if you're making enough money, it's real simple. You save 50% and you spend 50% on your lifestyle. Easy. Okay. Just make it that easy. Okay. And then that 50% that you're saving, split it up into a portfolio. Make sure at least half of it is liquid so that you can pay taxes when and if you need to. Okay. That's the 50, 30, 20 plan. If you can't do that, and that's okay, that's probably almost all of us, okay? Most of my life, I've not been able to do that, okay? So then what are you going to do? Okay, I read this book growing up. It's called The Automatic Millionaire, okay? Great book. I totally recommend it. Go out and get it. You're going to start saving as much as you can, okay? You're just going to develop a habit of savings. If you've got one account that's going up, that is going to psychologically change your relationship with money. Most of your accounts are going to be going down. You're spending a whole bunch out of them. You need one account. All it does is go straight up. And even if it only goes up by $5 a day, the Automatic Millionaire said, hey, don't go and spend $5 on a cup of coffee every day. Instead, put that $5 into an account and start saving it. And instead, go get the 50-cent coffee. Okay. And that's what you got to do. So I got an app called Acorns. I think it's an amazing app. There may be other apps out there that do that, but Acorns lets you basically round up your change. So it takes the change of all your transactions. When it equals $5, they take out $5 from your account, and then you can also have a daily withdrawal. Okay, $5 daily withdrawal, and then it takes that and it buys micro shares of ETFs. Okay. And it invests that for you. And then that goes up with the market. And I became very successful with having this account just start going up. And when, for a long time, I wasn't able to save $1. And then all of a sudden I got $400. And then all of a sudden I got $1,500. And then all of a sudden I got $3,000. I never had $3,000 in my life. This was 20 years ago. I was like, oh my gosh, I have $3,000. That's amazing that I don't need it. I don't have to spend it on anything. I didn't even feel it. I didn't know that I could do this. So go out and get Acorns, develop a habit of savings, start to work towards the 50, 30, 20 plan. Okay. Start building wealth. I want you to keep more of your money. Do I want you to save in taxes? Yes. Okay. It's very personal. It's very private. Everybody's portfolio is a little bit different. Everybody's financial, stack, if you will, is a little bit different. Okay. So how you can save money on taxes is different than the other people. But the major games to play is the real estate game that I explained to you. It's starting a business. Okay. Because you're going to be able to, put all of that money into the investment in that business, all the expenses you're going to do, so on and so forth. Okay. But once that business becomes profitable, then that's not saving you taxes anymore. It's just saving you taxes while you're building it. Okay. And then, there are tax deferred programs, retirement plans, and things of that nature. But I'm going to be real honest with you. The number one thing that you need to do is not focus on how can I not pay taxes, because that mindset is not going to get you the wealth that you're trying to develop. You need to first focus on earning those dollars and saving those dollars. And then when you've got some money to work with, then you can begin to develop complex strategies to protect it. Thanks so much, everybody. I'm Sloan, and I hope you have an amazing day out there.